Hello there, welcome to this edition of Global Business Africa. In the next half hour, we'll make your usual run through all the key business news stories that are making the headlines across the African continent, and of course those that aren't, but still are certainly of interest to you. Here's what we have lined up. The US Federal Reserve ends QE. How will this affect African economies? We'll tell you. South Africa emerges as a top destination for medical tourism. We'll have the details. And desperate times do demand desperate measures. Kenyans are seeking alternative ways to survive in fairly tough economic times. Now, let's start on the other side of the pond, where late on Wednesday, the US Federal Reserve waved goodbye to its third quantitative easing program. The question we're asking today is if we ought to roll out the welcome mat for another round of volatility in global financial markets. Now, according to the IMF, African economies that are reliant on flows of short-term capital will be badly affected by any such volatility. And that brings us to the case of South Africa, a country that has been beset by a potent cocktail of low growth and high inflation and inflexible government policy. Sumitra Naidu starts us off tonight by asking how South Africa can adapt in a world without QE.
South Africans are in for more pain. A stuttering economy, low growth, rising unemployment, and now the decision by the US Fed to finally stop its 6-year quantitative easing program. Improved US growth will see rates rise in the United States. South Africa will have to do the same.
Now we've got to actually see consumers cut back, government cut back, and interest rates rise in the face of that slowdown. It does suggest that slow growth will be with us for some time, which means unemployment will be with us also for some time, and at the same time inflation will remain high because of the deficits and the weakness of the rand.
It may be a shock to the system, but it came as no surprise. The US had warned in January 2014 that it was planning to stop the tapering. But most major and emerging market currencies, including the South African rand, fell on the news as the dollar gained momentum.
The end of quantitative easing was pretty much priced in, but I think what moved the market is the fact that the tone of and the language out of the Fed was a little more hawkish. So we saw the rand kind of trade from 10.85 to 10.96. It's come off, it's come off today again, but it's really factored in terms of a stronger dollar.
Analysts predict the US Fed will start hiking rates mid-2015, but for South Africa, it may happen as soon as January.
For the South African economy, we may well have to see interest rates hike again, because if the markets roll over to risk off, it means an outflow. We've got a deficit with the current account. It does mean that there's quite a bit of vulnerability to the rand that'll push inflation and the need to actually hike rates as a consequence.
When the Fed starts raising rates, I think risk-free rates in general are going to be going higher. So it is going to mean that the rand is going to potentially get a lot weaker if we haven't raised rates fast and far enough.
The highly indebted South African consumer market is now expected to come under significant pressure. The country's finance minister has also hinted at possible tax hikes next year. Sumitra Naidu, CCTV, Johannesburg.
We'll be live in London with some more insights into what QE means for African economies and, of course, African sovereign debt issuers a little later. But first to West Africa, where Air Cote d'Ivoire has resumed flights to the 3 countries worst hit by the Ebola outbreak in West Africa. The carrier's CEO said local safety precautions and the passenger screening processes that are in place right now are proving to be effective. And that ideally should make it slightly easier for aid workers to travel into the region, where over 4,500 people have died so far. Bernard Gustin added that Ebola curbed general travel to Guinea, Liberia and Sierra Leone, and that's been offset, however, by a surge in trips related to the relief effort, leaving demand for travel, on balance, little changed. Aid workers now make up a majority of the clients in some flights. Many airlines, of course, did stop serving the 3 countries way back in July, including the Kenyan carrier Kenya Airways. Brussels Airlines NV is the only European airline that still flies to all 3 nations. Now, African governments seeking to stem illicit cash flows may have a reason to smile after over 80 countries signed an agreement in Berlin that could end banking secrecy, tax evasion and fraud. Now, the deal, to give it its formal name, is known as the Multilateral Competent Authority Agreement. It's a bit of a mouthful, but it's the end result of 2 days of talks by the Global Forum on Transparency and the Exchange of Information for Tax Purposes. 51 countries signed the agreement, which compels them to put in place systems to automatically exchange data between participating countries starting in September 2017. The aim is for every country to be kept fully informed about the offshore holdings of its citizens. About 30 other countries pledged to join the agreement from 2018. Estimates from some recent studies reveal that between 1970 and 2008, African economies as a whole collectively lost anywhere between $854 billion to $1.8 trillion in illicit financial flows, most of those from the extractive sector.
Europe has evolved. The world is connected. Communication technology means it's easier to transfer money across continents and therefore not pay taxes. That is why the automatic exchange of information is a pragmatic and effective way to deal with the problems of global governance.
I'm proud that Britain has been able to work alongside close allies like Germany and the others in this room to bring this about. And it is remarkable how much progress has been made in such a relatively short period of time in a field where normally it takes decades to get international agreement.
Now, let's get back to our lead story. The end of QE, what effect will it have on African economies? Let's get some feedback from Melanie Ralph. She's been looking at the markets live from London. She joins us from the city tonight. Melanie, in May last year, the announcement that the taper would begin ruffled markets, to put it mildly. What's the reaction been to Wednesday's announcement so far?
Well, yet the 2-week rally has come to an abrupt halt following the US central bank's announcement yesterday. As expected, the Fed ended its massive bond buying program, but the tone was far more hawkish than was anticipated. There was no mention of a slowing global economy with worries from the likes of China and here in Europe, but more comments about a strong labour picture in the US, not to mention playing down the risks of below target inflation, despite the central bank sticking to an assurance that it will keep short-term interest rates at near zero for a considerable time. Some analysts say if economic data continues to improve for the US, we could see a hike sooner than expected. As expected, the hawkish tone has sent equity markets taking a tumble today here in Europe.
Indeed. Let's focus on what the South African Reserve Bank has been saying. It's been quite critical of the forward guidance coming out of the Fed. They argue that the timing and the size of interest rate hikes is uncertain, as is the net effect. Now, that criticism isn't new, but what is it exactly that central bankers around the world want to hear from the Fed?
Well, the rate hike really will be the market mover when it happens. At the moment, the signals are very much mixed. On one hand, we're hearing a very dovish tone from the FOMC member James Bullard, who suggests the Federal Reserve delay the end of its bond buying program. But then we get a relatively hawkish announcement from the Fed just yesterday. Now, we know that markets hate uncertainty, and these kind of mixed signals do just that. Then we have the effects of the US dollar and who gets hurt by its fluctuation. The likes of South Africa's market is reasonably vulnerable to tightening. The timing and size, as you say, of the interest rate increase will no doubt affect their capital flows.
Indeed. Finally, Melanie, as the dollar rises after the end of QE, how exactly have African Eurobonds responded? And to what extent is the dollar appreciation a threat to debt service, if any?
Well, the dollar's rise in the expectation of a turnaround in the stance of the monetary policy on the back of better economic activity will, among other things, make the US market more attractive for international investors. This could detrimentally affect the flow of portfolio investment across the continent of Africa. Up until now, African Eurobonds have offered a decent yield return compared to others, but as the interest rate differentials shift globally, investors may opt for less risky investment. Just last week, the IMF warned African countries against rushing into issue Eurobonds over fears they may face exchange rate risks and problems repaying debt. So it's certainly something African countries should start considering now before we see the US tighten policy.
Certainly, we'll keep tabs on that. From London, that's Melanie Ralph in the city for us. Now let's move on to Zambia, shall we? It's one of the leading destinations of FDI inflows in Southern Africa. But could the death of President Michael Sata, the Africa's second biggest copper producer, slow down? Farai Makutua examines the potential fallout, as far as policy is concerned, from his death.
The news that rocked the nation has already made a dent in the economy too. The Zambian kwacha slipped against major currencies Tuesday, a development policymakers expected and which they say they're working to manage. The Zambian Central Bank issued a statement on the currency market's reaction, saying, "At a time like this, it is expected that financial markets may become unsettled, leading investors and individuals to take measures that reflect market uncertainty rather than any change in the fundamental strength and resilience of our economy. Consistent with our policy of operating a flexible exchange rate whilst minimizing volatility, the Bank of Zambia stands ready to support the market as required during these difficult times." It's not just the big businesses that will be affected, though. The streets of Lusaka are a thriving market for street vendors and traders who make their living here. But just last year, they had been banished from doing business on the streets. That was until former President Michael Sata came to the rescue, blocking that move, calling them his people, and allowing them to continue to earn their livelihood.
So we are mourning, and the nation is in deep sorrow because the president allowed us to share in the streets. So we'll miss him very, very much.
Now that he's gone, do you fear that you could be thrown off the streets again?
That's another fear that we have so far. So we are going to wait for the next president whom the Zambian people is going to vote.
He won't be the only one playing the wait-and-see game. International investors are likely to hold back until fresh elections determine the next government.
They are not sure the direction that the country will take. They are not sure in terms of whether there will be policy reversals and so on and so forth. So it's only prudent that let this period, or transition rather, spin out, and after that, decisions going forward will have to be made after that.
But analysts say Zambia has been down this road before, following the death of former President Levi Mwanawasa, and therefore this market can survive the impending slowdown. Fresh elections will be held within 3 months. Farai Makutua, CCTV, Lusaka, Zambia.
Quick run through the equity markets here for you. Red ink with regard to the markets in Nigeria and the JSE All Share in South Africa, down by over 0.4 in each particular market. With regard to the NSE 20 in Nairobi, however, some results coming out of Equity Bank, a 25% rise in pre-tax profits to about $177 million in the 9 months to September. The new listings coming your way to the NSE will have the Managing Director of Flametree next. And South Africa is emerging as a top destination for medical tourism. If you want your nip and tuck done somewhere, stay tuned for this. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast-changing African business landscape. We take you where the business is happening.
We do know that the strike isn't anywhere near close to coming to an end either. That means that those workers are going to sink even further into poverty.
Welcome back to the program. The Kenyan cosmetics and plastic tanks maker Flame Tree Group is set to become the second company to list under the growth enterprise market segment of the Nairobi Securities Exchange. Now, the company has wrapped up a private placement process. It raised about $2.2 million at a subscription rate of 158%. Now, Flame Tree can now go ahead to list all of its issued share capital on the 6th of November. The group was founded by the current managing director, Harold Bagera, in 1989. It has operations in Kenya, Rwanda, Ethiopia, Mozambique, the DRC, Burundi, Sudan and Mauritius. Now, Flame Tree will be the second company to list on the GEM segment after the real estate developer Home Africa in July last year.
We see this as a great opportunity for retail investors, a great opportunity for the group itself, because when you're listed, you can attract more capital.
As I mentioned earlier, Harold Bagera is the managing director of Flame Tree. He's live with me in studio right now. Thank you for your time. It's awesome to have you here. Tell me, why list by introduction at the NSE and not raise the capital you want by private equity?
We looked at private equity as an option to raise capital, and every time we looked at them, we saw that their objectives were not aligned to our long-term objectives. We believe that they wanted to come in, take majority stakes, and eventually exit the business. They didn't seem to have the long-term goals that we had as a business. We as ourselves believe that we want to be a pan-African multinational. We believe that manufacturing within Africa is good. We felt when we were approached by various private equity, most of the time they were looking at exiting and making a big profit.
And usually over a fairly short period of time, 3 years.
Yes, about 5 years' time. And so we felt that our goals were not aligned. We ourselves wanted to have a long-term goal, which is to be a company we in Africa believe in, we are confident in, and we feel happy to belong to. And we felt the most of the private equity was just looking to make a quicker buck.
All right, let's look at the business in detail though. 2013 revenues, 1.6 billion Kenyan shillings. Can you break this down for us by your business lines? Because when I was looking at your numbers, I mean, you've got a fairly diverse mix of products that you cover, everything from plastic tanks to cosmetics to food as well.
That's right. We actually divide our businesses into manufacturing and trading. However, since your question is to segregate the different lines of business, plastics constitutes our top line of about 56%. FMCG is about 26%, and trading is about 17%.
When you say trading, what exactly are we looking at?
We
trading of plastics?
We have a trading arm in Dubai where we trade in polymers, and we have a hardware set of stores in Rwanda as well.
Right, moving forward though, your core line of business has been in these roto water tanks. It's a fairly dominant brand, if I may put it that way, across East Africa. What prompted the diversification though into these other business lines, the cosmetics, the polymer trading and so on?
Roto was a business which I started very early in my career when I was about 18 years old. And as we grew the Roto business through the various countries, I realized that the purchasing power within the populations in the countries that we operated were growing. We saw an opportunity within the FMCG lines. We saw that most of the FMCG products sold in the region were by multinationals, mostly coming from the European or the Western world, and they were bringing their models here, which were eventually the product was at a high price point. So we wanted to make a product that was had a good quality and was at the right price point for the people in Africa. So we started with a brand called Zoe, and then expanded. We saw the opportunity within FMCG and expanded into synthetic hair and food products.
And presumably the market for synthetic hair is massive across Africa.
Of course. We believe there's a lot of opportunities in all the businesses that we operate in, and we see growth within all the businesses that we operate in. I think Africa as a whole is a good growth story, and we seem to be at the right time at the right place.
All right, certainly looking forward to your shares coming online on the 6th of November, is it?
That's right.
6th of November at the NSE. All right, we'll have to leave it there, unfortunately, but thank you for your time this evening.
Thank you.
Best of luck, sir. We've been talking to Harold Bagera. He's the managing director of the Flame Tree Group. They'll be listing, of course, at the NSE by introduction on the 6th of November. Let's take you to South Africa now. The relatively high standard of that country's healthcare system, at least compared to the rest of the sub-Saharan African continent, is attracting clients from all over the continent. Every year, it's estimated that about 400 200,000 people travel there, either for specialized help, emergency help, and even cosmetic surgery. The first of a two-part story, Sumitra Naidu explores this lucrative medical tourism.
South Africa is one of the most medically advanced countries on the continent with a large network of public and private hospitals. South African surgeons are also well known for their expertise in cardiology, oncology and various other areas of medicine.
Push factors pushing them to South Africa are doctors in those countries saying that, we just don't really have the service here, or friends and relatives and family or other connections of the patient saying, it's not so good in Angola, but we went to Mill Park and we had a great experience. And so they're coming here for the perceived better quality of care factor.
Companies like Black Plan and ER24 evacuate and transport people from other parts of the continent to medical institutions in South Africa. These people require a range of services, from regular healthcare checkups to critical care and emergencies.
Places like Angola, where the healthcare system there is not bad, but just really nowhere near as good as ours. And then a lot of it falling in that sort of lower socioeconomic kind of bracket, which we unfortunately don't get to see. That's happening from static neighbouring countries where we've got horrendous public health systems like Zimbabwe and Mozambique and so on, where they just don't have services.
At the moment, it's really focused around the private healthcare market and the private insurance market. So pretty much anyone that is insured through one of the global insurance companies would have an ability to get access to private healthcare back in South Africa, and obviously to be evacuated by a company like ourselves.
While 75% of the middle-income population who travel to South Africa are insured, there are many low-income earners that cross the borders into South Africa and use state facilities which are already overburdened.
Medical tourism in general is perpetuating this divide. By pulling in foreigners and putting them in the private sector, all you're doing is you're just empowering this divide between the very good and the really not so good. So the whole concept of people moving across border has been criticised as making our public health systems struggle more.
The reality within our country is that our public sector is overstretched. We've got a high burden of disease within our own country, so the focus from a public perspective will always be on its own citizens. So in terms of infrastructure, they do have it, but the priority's got to be our citizens right now.
But experts say that South Africa can use the influx of people wanting healthcare to boost state coffers.
The governments in some countries have actively targeted 1 million medical tourists into their country. If we took that same sort of approach and pulled in a lot of people and became a country of medical excellence, now you've got more resources flowing into the public health system.
However, the industry is not regulated and state hospitals are reluctant to treat foreign patients.
The biggest thing we struggle with is governments that are taking a bit of this is a dangerous sort of territory, and are very reluctant to go into this cross-border phenomenon and provide a regulatory structure and that enables this type of work.
Even though thousands of patients are treated annually in South Africa, no formal medical service agreements are in place. Experts believe if governments agree on sharing services, South Africa could raise revenues and further improve its healthcare infrastructure. Sumitra Naidu, CCTV, Johannesburg.
In the next 24 hours, we'll be looking at cosmetic surgery in South Africa. In recent years, the number of people travelling to the country for such nip-tuck operations has been going up. Sumitra Naidu will have those interesting details on those medical safaris a little later on tomorrow. Let's make a quick run through commodity prices. A day of red ink across the board. However, our focus is on cocoa. Ecobank releasing its update on soft commodities today. Fairly interesting read here. The highlights. Forecast for Cote d'Ivoire output down about 8% to 1.6 million metric tons next year. And of course, Ghana as well will be rising by about 6% to 950,000 metric tons. We'll have details on that and plenty more later on tomorrow. When we come back, desperate times, of course, do demand desperate measures. We'll tell you how Kenyans are adapting to the tough economic times and the squeeze on purchasing power households are facing. Welcome back to the program. Now, Kenya, of course, did rebase its GDP last month, went up to about $53 or so billion in total, 25% higher. That revision lifted the average per capita income in the country to about $1,246, effectively making Kenya a lower middle-income economy. That said, despite the growing middle-class narrative, poverty levels in Kenya are still high at about 45.9%. Mahia Muto tells us of the rise of Kenya's Kadogo economy, quote-unquote, in Grassroots tonight.
Shoes, food and a variety of clothes. Everything you need, all under one market. Welcome to Kenya's lower income economy, or better known as Kadogo economy in Swahili. Majority of lower income earners flock to markets such as this, Gikomba Market, for their shopping. Considering that it's the biggest market in East and Central Africa, traders sell almost anything at an affordable price.
Gikomba Market was created to help ordinary Kenyans. And take a look, you can find anything at an affordable price compared to malls in upmarket areas.
I prefer buying shoes here because they last. In town malls, they're expensive, and most of them are imitations of the real thing.
Despite a rebasing of Kenya's economy to a gross domestic product of $53.4 billion in September this year, majority of Kenyans still live on less than $2 a day. They have to squeeze the income they get to eke a living.
We like shopping here at Gikomba because we can shop according to our means. Here, we can buy second-hand clothes at a cheaper price because we cannot afford to buy new clothes from the shops.
As a Kenyan, I buy goods here because they are affordable. Majority of Kenyans don't have money. That's why they shop in places like this.
With a population of about 44 million people, the revised GDP figure implies economic output per capita stands at more than $1,200, giving an indication that Kenyans have more money to spend. But analysts say the new status and a bigger economy have no direct impact on the lives of ordinary Kenyans.
That an increase in GDP per capita does not necessarily mean that Kenyans will be better off, nor does it imply that the existing socio-economic challenges have ceased to exist. Kenyans will be just as poor or just as wealthy as they were a year ago.
For now, traffic in Gikomba Market will continue to surge as more lower-income earners prefer this mode of shopping for their daily needs. Mahia Muto, CCTV.
As far as currencies go, what the Fed taketh away with one hand, Jill Marcus giveth with the other. Or at least that will be the argument that could be made about the South African rand. It did drop after the Fed statement yesterday, but it regained some of its earlier strength against the greenback in trading today when the South African Reserve Bank defended its inflation targeting policy. Now that's it for this edition of Global Business Africa. Thank you so much for watching. Do remember you can send your feedback to the program at globalbusinessafrica@cctv.com, and of course when we're not on air, or always on Facebook and on Twitter. The news continues over there 24/7. We'll see you in the next 23 hours. I'm Ramanya.